Welcome guys, welcome to the channel. Thanks again for joining us. Don't forget to like and subscribe. In today's video, we're going to cover 1031 exchange, what it is and how it can benefit your real estate investment business, and how you can grow your portfolio utilizing the 1031 exchange strategy. So first off, what is 1031 exchange, and also known as a like-kind exchange? It's a tax deferral strategy that allows an investor to sell a property and then purchase a new property using the proceeds from the sale without paying taxes on capital gain. Basically, it allows you to defer your tax obligations from the sale of a property and defer it by putting it towards the purchase of another like-kind property. And this is done following specific rules and guidelines set forth in Section 1031 of the U.S. IRS Code. And that's where the name apparently comes from, is 1031 exchange, is from Section 1031 of the United States Internal Revenue Code. So first off, before we get into the details on how 1031 exchange works, it is very important to remember that you do need the assistance of a professional, in this case a lawyer or a CPA or someone who practices in tax law. So I definitely encourage you to reach out to and work with an attorney as you're doing a 1031, so that you can do it properly and are not in violation of any IRS rules. So what does the requirements for a 1031 exchange? Well, the property involved have to be like kind. And what does that mean? It means that the properties must be used for investment or for business purposes and have to be similar in nature or character. So what does that mean? For example, if you are selling a property that is a multifamily apartment complex, then the replacement property has to be another multifamily apartment complex. Now, again, you would need to discuss this with a professional, but typically there are ways that you can probably replace a multifamily with a single family property, as long as it's used as an investment property, for example. And there are ways and there's certain restrictions that you need to be careful about. So again, talked with an attorney, but this is essentially what like-kind means. Another restriction that you have to be aware of when you're doing a 1031 exchange is that there is a time limit in order for you to replace this property. You have 6 months or 180 days from the time that you sell the property until the time that you replace it with the 1031 exchange property. And you have 45 days to identify the replacement property. And then another stipulation as part of doing a 1031 exchange is that you have to do the exchange through a qualified intermediary, or a QI. So in this case, you'll need to put the proceeds or the profits from the first property into an escrow account where you do not have access to. Again, this is why it's very important that you reach out to a professional to do this. You can't touch the money or have it commingling with your personal account or your business account. The proceeds have to be sitting in an escrow account until you identify the replacement property and until the closing of the second property. And another very important stipulation is that the investor must purchase a property of equal or greater value than the property that you're currently selling. I'll give you an example in a little bit, but essentially what it means is if you're selling a property that is worth $100,000, then the property that you're replacing it with when you're doing a 1031 exchange has to be a value of $100,000 or more. So it's very important to remember this. You cannot use the proceeds to buy a lesser valued property. And another stipulation to remember is that when you're reinvesting the proceeds from the sale of the property that you're selling into the replacement property, you have to use the entire amount. You cannot use a portion of it, 50%, 90%. It has to be the entire amount. So again, this is a very important thing to keep in mind when you're looking to identify a replacement property. You have to use the entire amount. In addition, there are some specific rules on the type of property that can be exchanged and the way the ownership should be held, as well as certain forms that need to be filled with the IRS. So again, it is very important that you consult with a tax expert or an attorney before proceeding with a 1031 exchange. So let's look at a specific example. You have a house that you currently own. Let's say we call this house A. And house A is worth $100,000, but you bought it for $80K. So which means that you have a $20,000 profit that you can use to roll over to the next property. And let's call the next property house B, or the replacement property in this case, the 1031 exchange property. So in this example, once you close on house A by selling it, you would at this point take the $20,000, put it in escrow account using a QI or a qualified intermediary, and then they would hold that fund until you identify the replacement property and put that property under contract and close on it. So in this case, you would have to identify a property that's worth at least that's valued at $100,000 or more, and you would use the entire $20,000 towards the purchase of that property. Now, why is this 1031 exchange so valuable? Well, if you would have otherwise tried to take the $20,000 and put it into your bank account and then try to look for a property to buy, well, then you would be responsible for capital gains taxes. You have to pay capital gains taxes on that profit of $20,000, and the capital gains tax could be anywhere from as little as 20% if you own that property for over a year, or as much as, depending on your income bracket, as much as 40%, and depending on the profit amount. So as you can see, instead of having to pay a percentage of that profit, taxes on that profit before you look for the next property, you can roll that over to your next deal. So that way you have more money to use on your next deal, and it allows you to grow faster, and it allows you to defer your taxes indefinitely, right? Until you sell that final property, and at that point you would be responsible for it. But we can discuss more on how people typically roll over proceeds from one sale to another, to another, and to another, and they typically do this for years, decades. Some people have done this for their entire life, their entire real estate career, and then eventually they pass that profits into their kids. And then you can also do a cash out refi, where you can pull out the $20,000 and cash it out without paying any taxes, because at that point it would be a cash out refinance as opposed to cashing out the actual profit. All right, guys, thanks again for watching this video on 1031 exchange. If you want me to do any more in-depth or follow-up video, if you have any questions, please comment below. Don't forget to subscribe and like the video. Thanks again. Until next time.